Okay, so today we are going to be talking about the Home Buyers Fund of the Victorian government. This is not a grant, so a lot of people are confused on how this is supposed to be used. It's basically an allocation of a certain amount of funds from the government with an intent to become a partner, a shareholder in your home purchase. Up to a certain percentage, they intend to contribute towards your deposit and have and hold the co-ownership of your home purchase. So, hi, my name is Amit. I'm your professional buyer's agent. I help you build self-sustainable property portfolios, targeting short-term growth, high-yielding properties without compromising on long-term growth on the basis of data and research. So, as I said, a home buyers fund is actually a fund. It's not a grant, and that is why a lot of people are confused on the use and the way they can utilize this fund. So what the government intend to do here is they basically are saying that as long as you have around 5% of deposit for your home loan, they can possibly lend you up to another 25% to make it 30%. And then you can borrow 70% from the bank and buy a house. The key elements on how this is different from other grants and programs available at the moment is that this is not actually for just first home buyers. Anyone who does not hold an ownership interest in a property and does not own anything, regardless of whether they have previously owned or not, they are able to buy a family home, a home to live in using this scheme. So I'm going to be sharing my screen with you, and I'll take you through the government scheme and the basic key criterias and the explanation of the whole thing. Okay, so here we are. This is the State Revenue Office's website, which has an explanation of how this fund is going to work. So from the very beginning, it says you may be eligible to receive a contribution of up to 25% of the purchase price of your home. Further, it also states that for eligible Aboriginal or Torres Strait Islander home buyers, this contribution is up to 35%, and the minimum required deposit is 3.5%. So for everyone, it is 5% minimum deposit, but for Aboriginal or Torres Strait Islander people, this is 3.5%. And as I mentioned earlier, this fund is a shared equity scheme, meaning that the state's financial contribution is made in exchange for a share or proportional interest in the property. As the value of the property changes, the value of the state's share, so the government share, will increase in value as well as the value of your property changes too. So they have very clearly marked the criteria over here: financial contribution, minimum 5% deposit from you, 25% from the state of Victoria, and 70% from the chosen lender. The criteria is also very clear. It has to be a house in an eligible location. The income criteria actually is 125 per annum, 125K per annum for a single person, and up to $200,000 or less for joint income families. There are certain ongoing obligations as well, which we'll discuss further as we move forward. So let's quickly dive into the eligibility criteria. So the main criteria dictates that you must be an Australian citizen or a permanent resident who is at least 18 years of age at the time of settlement. They also require you to have at least 5% deposit or 3.5% deposit if you are Aboriginal or Torres Strait Islander. If you are an individual, your income should be $125,000 per annum or less. For families with joint incomes, this can be $200,000 per annum or less. And this is actually the gross annual income. The property purchase has to be for your principal place of residence, straightforward and simple. You must be a natural person. That means you shouldn't be acting as an entity like a company, trust, or organization. You shouldn't be purchasing. You cannot purchase a property under this scheme from a related person. Also, to be eligible, you have to be not having any interest in any other land at this time, at the time of purchase, including being a trustee or owner of a company and owning a property through that sort of structure. Further here it says shouldn't be acting as a trustee or a trust. Also, you cannot be a shareholder in a corporation which owns any land apart from a shareholder in a public company. They also further talk about the eligible locations and properties. So what they've done here is they have actually put Metropolitan Melbourne and Geelong in one category, and all other regional locations as regional locations. So there's a whole list of regional locations available on the SRO's website. I'll actually put this link down in the description. And there's a whole list of regional locations which are eligible for this scheme. The only difference between Metro Melbourne, Geelong, and other regional areas is that if you're buying in Metropolitan Melbourne or Geelong, then your maximum purchase can be up to $950,000. Or if you're buying in any other regional location which is approved under this scheme, then you can go for a purchase of maximum $600,000. It can be an existing or new property, provided that the certificate of occupancy has been issued prior to the date of the contract of sale. So what this basically means is of the planned property purchases are not eligible. Straightforward. Now, there's a number of other ongoing obligations which I'll leave to you to get your head around this, because these are very subjective and some are a little complicated to explain as well. The simple ones are like insurance. You have to maintain your insurance. You have to maintain your property. Obviously, you have to make the repayments from for the borrowed money, which you will get from the bank. You have to pay for the associated costs like legals, transfer costs like stamp duty, etc. If you are a first home buyer, then obviously the benefits of other schemes will be applicable to you. For example, you might be exempt from stamp duty for the purchase of up to certain amount. How to apply, instructions are over here. What I want to emphasize on is certain key elements which are important for everyone to know. So we'll go into the frequently asked section of this website and have a look through quickly. So at this stage, banks, the lenders, there is only 2 banks approved to be participating in this scheme. There might be more banks jumping into this at the future stage, but it's not clear at the moment. And right now, there's only 2 banks. So that is Bank of Australia and Bendigo Bank, who are participating in this scheme. So if you are looking to borrow under this scheme, you will have to go to these 2 banks or speak to a broker who actually works, provide the products for these banks. At this stage, you cannot use any other bank. Straightforward. You must have at least 5% deposit, and there are other costs involved. If you're eligible for a first home owner grant, then obviously you can use that in conjunction of this scheme. So it just makes it a lot more easier for first home buyers. And then there is restrictions on where I can purchase a property. So as I mentioned earlier, there are certain locations which are published for being eligible, where you can buy property under this scheme. Can you buy an established home? Yes. Can you buy a new home? Yes. But the certificate of occupancy of that house must have been issued by the date of signing the contract. Will you still receive first homeowner grant? Yes, you will. Will you need to pay the stamp duty? Yes, you'll be required to pay the usual amount of stamp duty as it may apply in your scenario. Now, the most important factors to notice here are as the government has an income threshold for you to be part of the scheme, they will be doing annual reviews of your income once you become a participant and you have bought a house under the scheme. And what that means is that for any 2 consecutive years, if your income threshold goes beyond the permitted one, then you'll be required to start paying back the government's share in your house. And that share will have to be paid back at the value of the property at the time of those repayments. So it can actually be more than what the initial government contribution was. Apart from this, you also have to keep in mind that when it comes to probably sell the property or you want to get out of the scheme, then the government's share is actually more than what they initially contributed, given the values of that property have increased over time. So the government will be actually entitled to get the actual value of their proportion of contribution. For example, if you have bought a house of which is worth $400,000, and the government has given you 25%, which is $100,000, and the value of that property is now $800,000 when you're selling it, then the value of the government's proportion will also have doubled from $100,000 to $200,000. So you will actually be paying them the real value of their proportion at the time of the sale. So you'll have to keep this in mind when it comes to payback. The government will actually be seeking payments in terms of the real value of their share at the time of assessment when it comes to those payments. Another key element of this scheme is that you can actually pay the government's interest in your property on a voluntary basis as well. So basically what you will have to do is, if you want to make voluntary contributions, your payment will need to reduce the government's interest by at least 5%. That is from 25% to 20%. So with every voluntary payment, you have to be reducing the government share by 5%. And why they're talking in percentage is because they will be valuing your property on that date, and based on the current value of the property, they'll be asking you to pay a percentage. So it won't be based on the actual monetary value of the government contribution, which was the initial value, but it will be based on the current value at that time. And they also mention here that you cannot actually pay the government's contribution in the initial 2 years without a written consent from the Homebuyer Fund team. So you'll have to seek a special approval or a special sort of permission for that. So that is it, pretty much straightforward. It's not a grant. It is basically government participating, becoming a shareholder in your house, buying a portion of equity, contributing towards it. And when it comes to pay them back, you will have to pay them at the future value at that time, based on the percentage contribution of the government. Only 2 banks are available at the moment to participate. You should have at least 5%. You shouldn't be owning any other property at the time of purchase or signing the contract. You could have owned property in the past, so it is not just limited to first home buyers. It is open to anyone who does not own a property to live in. So it has to be a primary place of residence. You cannot buy for investment. You have to actually go and live in that property. There are certain areas and certain price limits. So in Metro, Melbourne and Geelong, the price limit is $950,000, and other regional areas which are actually marked and listed on the SRO website, the maximum purchase price is $600,000. So that is it for today. I'll see you again. Thank you.